Smart Business Account for SMEs. Being a business owner is a role that changes constantly. At JMMB Bank, we offer a new type of partnership. We understand and care about the unique needs that come with operating a small or medium-sized business by offering flexibility, partnership, and expert advice to support your successful growth. For you, we've created the JMMB Smart Business Account. The JMMB Smart Business Account is an interest-bearing checking account for registered businesses with an annual revenue of under $450 million, or US dollar equivalent, which gives you the opportunity to maximize the value of every dollar earned. The benefits? No nuisance fees. Never have to deal with monthly service fees, account dormancy fees, and minimum monthly balance requirements. Easy payments. Enjoy free bill payment and free inter- and intra-bank automated clearinghouse ACH transfers within Jamaica. Interest accumulation. Earn interest and grow your company's money over time. Interest is calculated daily and paid monthly. One free manager's check per month. Check leaves available upon request, or ask about our special pay-as-you-go check feature. Speak to a JMMB Bank representative today to see how the JMMB Smart Business Account, along with our Small Business Loan Solutions and SME Resource Center, can support you in growing your business. Follow us on Facebook, Twitter, Instagram, and LinkedIn at JMMB Group, or visit our website, jm.jmmb.com. JMMB SME Resource Center, a partnership that goes above and beyond. Because you need more than just a bank, we are committed to offering support and guidance to small and medium-sized businesses, or SMEs, every step of the way. The JMMB SME Resource Center ensures that you are prepared to access JMMB's banking, investment, and insurance brokerage services, along with our business planning expertise. The center provides customized advice to take your business to the next level. The JMMB SME Resource Center will help you to identify financial opportunities, develop a professional business plan, structure financial statements, and solve business challenges with the help of our network of business partners. Are you ready to grow your SME with JMMB? Speak to one of our JMMB SME representatives to find out how we can partner with you. Follow us on LinkedIn, Facebook, Twitter, and Instagram at JMMB Group, or visit our website at jm.jmmb.com.
Good evening, everyone. Welcome to JMMB's workshop on debt versus equity financing. I'm Tanise, and on behalf of my entire team, thank you so much for choosing to spend this afternoon with us. It's customary here at JMMB that we begin each of our sessions with a word of prayer, as well as a section from our vision of love. Tonight, two of my team members, Vincent and Shauna, will lead us through that activity. Vincent?
Okay, good evening, everyone. Thank you, Tanise. Let us pray. Lord, we come to you tonight, giving thanks for life and asking for your guidance, wisdom, and support as we begin this workshop. Help us to engage in meaningful discussions. Open our minds to receive the information so that we may benefit from the presentations. This we pray in the mighty name of Jesus Christ, our Lord. Amen.
Thank you so much, Vincent.
Denise, I'll do the vision for you.
Thank you.
Just 1 second. All right. So from the vision of love, the JMMB team is clear that the organization is based on unconditional love and mutual respect. This love is expressed in ongoing day-to-day working relationships and performance. Unconditional love is expressed in every interaction and is the foundation upon which the organization rests.
Thank you so much, Natalia. So I hope you really enjoyed that section. And if it is that you would like to see what the entire document looks like, it's on our website, www.jmmb. Please go and read it. It speaks our core values. So tonight's session is being hosted by JMMB's SME Resource Center. And the Resource Center it's about partnership. What we do is we partner with our clients. We ensure that we help them to transition through the different stages of their business life cycle by ensuring that we know what their needs are. And in order to do this, what we do is we conduct needs assessment conversation with the objective of being able to identify their needs so that we can make the correct solutions or recommend the correct solutions for them. We also provide our clients with necessary business tools and mentorship, as well as we host a lot of workshops similar to the one that we are doing tonight. If it is that you would like to have a discussion in terms of how we can assist you with your business, please feel free to reach out to us at our email address, smeresourcecenter@jmmb.com, or you can visit us at our location at the New Kingston Business Center. However, tonight we're here to discuss equity versus debt financing and the difference between equity and debt finances, how to determine which one is best for your business, or whether or not a combination of both options is what is suitable. At the end of tonight's session, we really hope that you'll be able to answer questions such as, how does equity financing work? What is the best use of equity or debt financing? And how to identify the best type of financing for your business. We also want you to be able to identify the obligations that you would have as a borrower. We know that you're going to have a lot of questions. However, I'm requesting that you do keep your microphones muted during the session. And if you have questions, feel free to put them in our chat window and we will ensure that they are answered. To lead tonight's panel discussion, we have three of JMMB's expert team members. Natalia, who is our SME Resource Center in Trinidad, will introduce tonight's panel to you. Natalia, you can go ahead.
Thanks, Denise. So like Denise said, we have JMMB's experts here tonight leading the session. I'm really excited to hear what the panel has to say. So moderating the session, we have Mrs. Shani Duncan Faulkner, and just a little background on her. She's the Senior Corporate Manager of the Group SME Resource Center here at JMMB. Through the Resource Center, Shani helps high potential SMEs by facilitating access to the right resources to help them grow and develop throughout their business life cycle. She holds a master's in entrepreneurship from ESADE Business School in Barcelona, Spain, and a BS from the University of Maryland, College Park. She has over 16 years experience working with small businesses in various industries, and she's quite the regional person. She has experience in Trinidad and Tobago, Jamaica, and even the US. Currently, she's also a part-time lecturer at UTech in entrepreneurship and also sits on the PSOJ Access to Finance Facilitation Panel and supports a number of work streams within Jamaica. Right? And then joining us on the panel, we have two of JMMB's long-standing experts. We have Mr. Kevin Foreman and Kevin, you could probably give them a little wave so they know who you are. Kevin is a career banker with over 20 years continuous experience in the profession. He's been employed with JMMB Bank since 2013 and currently holds the position of Country SME Relationship Specialist. In this role, his primary responsibilities include leading the execution of country-specific SME strategic initiatives, ensuring exceptional client experience, providing technical expertise to our internal SME partners. He also ensures that our financial targets are met whilst adhering to all operational and compliance policies and coaching and development of the SME relationship managers. Prior to his role, Kevin has experience as a retail credit risk manager, and he was responsible for adjudicating on retail as well as SME credit applications. And he also balanced the growth of the bank's loan portfolio while maintaining a quality loan book by reducing undue risk to the bank. And he did this by identifying weaknesses in credit requests and, where possible, implementing mitigating measures. So Kevin is really the expert in terms of debt financing. And he's acutely aware of the importance of our SMEs to sustained nation building and is passionate about enabling them to achieve their potential. And then we have Mr. Kareem Tomlinson, who currently serves as the general manager of JMMB Securities. So he's our equity financing expert. And in his current role, he has oversight of and leads the team within the JMMB Securities entity. So in his role, he's responsible for driving the equity-related business line of the JMMB Group. And over his 12-year tenure with the group, he served in various capacities and amassed a lot of experience in areas such as private equity, investment banking, portfolio management, mergers and acquisitions, risk management, accounting, and customer service. Kareem also represents the group on a number of external associations, such as the Caribbean Alternative Investments Association, which is a non-profit organization dedicated to promoting the expansion of private equity, venture capital, real estate, private credit, mezzanine financing, and other alternative investments in the Caribbean. He also sits on the First Angels of Jamaica, the Caribbean's first angel investor network, which focuses on financing early stage companies in Jamaica and the wider Caribbean. He also sits on the investor panel of the Branson Center of Entrepreneurship for the Caribbean as JMMB's rep. Kareem holds a BSc in Maths and Econ from the University of West Indies, Mona, and has attained the prestigious CFA Chartered Financial Analyst and Financial Risk Manager designations, which have equipped him with strong technical and analytical skills. He's attended various professional training courses in venture capital, credit risk management, equity, and fixed income products. He also holds directorships on the boards of DRT Communications Limited, among many others, right? So that, I know it's a mouthful, but just to tell you that we have moderating the session and participating on the panel, the best of the best, you know, and I would really encourage you guys to soak in as much information, ask the questions at the end of the session. You have the right people here to answer your questions. So Denise, I'll hand back over to you.
We're going to now hand over to Shawnee. So we're going to go right into the session. So Shawnee is going to be our moderator for the night, and Kevin and Kareem. So we're going to kick off our discussion. You can go ahead, Shawnee.
All right. Good night, everyone. Good night, Kareem. Night, Kevin. Thanks for being here to show everybody and let everybody know what debt finance is versus what equity finance is. So Kareem, I want to kick it off with you, and we're just going to start pretty high level. You know, let persons on here know what is equity finance. When people say, okay, I want financing, but can I get equity? What does that exactly mean?
Thank you, Shawnee. Good night, Shawnee. Good night, Kevin. Good night, Natalia, Tanis, and everybody else, all viewers online. Thank you for that. So Shawnee, so what equity financing really is you know, you can think of it as representing an ownership stake in any company. So, you know, typically there are two different types of ways that a company can fund itself. One obviously being debt funding and the other being equity funding. You know, on the equity side, it really involves persons becoming shareholders in that company. So an equity investor will invest money in that company in exchange for getting, you know, some share ownership in the company. So they become, so for instance, a 20% owner or a 30% owner of that company. So at the very highest level, that's what equity financing represents. You know, it has a number of benefits and, you know, even some disadvantages that we can probably go through a little bit later. But at the very highest level, it really just represents an ownership stake in the company.
Okay. And you made mention to the percentage. Does that percentage always have to be set, or what does that depend on?
So it's definitely not set. You know, it's going to be depending on the amount of money that's being invested in the company, and secondly, what's the estimated value of that company. You know, so if a company is worth, you know, for easy mathematics, $100, and an equity investor is investing, say, $20, you know, that should generally translate to about a 20% ownership in the company.
Okay, right, got that. And Kevin, on the other end of it, because we want to see the comparisons here, on a high level, what is debt financing?
Good evening, everyone. So simply put, debt financing is where a company borrows money with the understanding that they will be making repayments over a period of time. And there are certain understandings that need to be met. So you can borrow from family, from friends, if you're starting a business, for example. You can borrow from yourself. You could lend your business money, or you could go the traditional route to borrow from financial institutions, such as JMMB, of course. So at the high level understanding is that you're borrowing money with the understanding that it is due for repayment over a period of time.
And Kevin just brought up there how you can get that financing, whether you go to a bank, whether you go to friends. But Kareem, when people are looking for equity financing, where do they go to get that?
So I mean, there are a number of sources, you know, as well, Shani, as Kevin alluded to on the debt side, you know, it applies just as well on the equity side. You know, so for companies that are generally at a startup phase, or you just have an idea that you want to test out, that first source of equity financing is typically from family and friends. You know, as a company develops and matures, then, you know, you unlock equity financing from different sources. You know, so there's angel funding, where, you know, angels are early stage investors who will come in, you know, with a bigger sum of money than family and friends. They come in with an intention to try and help to grow the business to the next level. As you mature and get even a little bigger, you know, you can talk about venture capital equity type financing, which comes in. As you get even bigger, you get into like the private equity space, you know, that is more focused on companies that, you know, are, you know, I would define as mid-sized. And as you get even bigger than that, the equity source that's, you know, hot on the tongues of everybody now is going to the IPO market, you know, listing on the Jamaica Stock Exchange. That is a source of equity that, you know, is available to companies that are a little bit more mature, have established a governance structure, you know, are now profitable and, you know, operating in a way that it becomes appropriate for listing on the stock exchange. So I mean, to sum up, there are a number of sources, and it's generally tied to the stage of development of the company, you know, which sources you're able to tap into at that point in time.
Okay. So with equity financing and both with debt financing, you can kind of get them at any stage where the business is at.
You know, and, you know,
go ahead.
You know, and just to say, to add to that, I mean, I think, you know, what makes the JMMB proposition uniquely ours is that, you know, wherever you are in that cycle, you know, we view ourselves as having a credible solution for fitting your needs. You know, some of which we can do in-house, some of which we have partnerships with external bodies that allow us to provide you the type of financing that you're looking for, you know, be it on the debt or equity side.
Right. So, I mean, when we were hearing your big title and, you know, everything that you're involved in, we heard about First Angels. So First Angels would be a partner that JMMB has within the Resource Center that would help with equity financing. But Kareem, in private equity at JMMB, what level would you have to be at for a company to come to you?
Okay, so I started by saying, for JMMB's private equity offering, we're looking for companies that we view to be mid-sized. And we've gotten a little bit more granular around what we think, what we define mid-sized to be. So we're typically looking for companies that generating revenues in excess of about 300 million Jamaican dollars. That's typically what our private equity offering, would start to kick in. As I mentioned, across the group, we have, for things that are way larger, we have an arm that can provide equity financing for those. For things that are smaller, we also have partnerships that we can unlock, such as the First Angels partnership that is able to fund early stage companies that are not yet at that $300 million marker level.
Right. Okay. So Kevin, in terms of when clients come to JMMB and they're looking for a loan, they're looking for debt financing, is there a figure that they have to come with? How is it determined how much funding they can get?
Well, the first thing is that the client in their business would see the need for additional funding to enhance. Usually it's for working capital support. Maybe they need to buy inventory, or it could be for larger items to buy machinery or even to buy a plant. Now, after the client ascertains that need and they come to have a conversation with us, our approach is to invest some time with that client, to sit and have a conversation, to understand where they're coming from, to understand their needs and the needs of their business. Remember that your business is separate from the person, but we love to understand also about the person, what drives the person, what causes you to get up every day and do what you do. And typically that will take between 45 minutes to 1 hour. I'd say it's a very good investment in time. And when that process is completed, it gives us so much understanding about the client. So we are in a position to offer you suitable and what we call fit for purpose financing, and not just to offer you things we believe, you'd want. So from there, you speak with the officer who takes you through that process, and then we'll speak about the other part of the process later on in discussion. But we sell from a needs basis. We don't push products onto our clients, and that is important.
Right, and that's perfect, because what you do is a client comes to you and you do a proper assessment of the client before you say, okay, it's this interest rate, it's that, what it's based on the client and their needs and
right.
what they can afford.
Right.
Perfect. So in terms of a client, Kevin, a client coming to you, what exactly, and I want to go now into a little more of the process, right? So for
right.
both of you guys. So a client comes into JMMB, they need a loan. Tell me a little more about the process. What happens?
So we sit and have that conversation, and we ascertain what your needs are. And some of those needs you may not be aware of. But after having that discussion, and we are agreed that debt financing is right for you, bearing in mind that if we ascertain that debt financing is not best for you now, we're going to have that conversation. After we've ascertained that, then what we typically do is tell you that these are the 5 or 6 things that we need, so we can make a presentation to our credit risk department on your behalf. What we are very careful of not doing is asking for 1 million pieces of information when they may not be required at that stage. And this is important because what does it do? When we say to you, give us these 4 pieces of information, and we are going to seek a conditional approval on your behalf, it empowers the client. At that point, you know that you will not need to spend additional money to get that conditional approval. So let's say we're going to want a valuation report or a service ID report. I can easily run you up to $200,000. We're saying, no, hold on, don't go and spend that money just yet. Let us make the presentation, get that conditional approval, give you that peace of mind that you are conditionally approved, and then you can go out and do all those things. We have seen where our clients have responded favorably to this modus operandi, or this way of operating. And it is something that we continue to refine.
So it depends on the clients, and then you work with them, and then you have a process that they follow in terms of figuring out how much they can get and how their repayment will be. But sometimes I hear people speak about debt service ratio and those things. What exactly does that mean?
So debt service ratio, or DSCR, that is, as it is properly known, it's essentially what it is your operating income, how much of your operating income can go towards debt servicing. So essentially, when you look at a simple income statement, and you see you have a gross income, cost of goods sold, gross profit, you have some expenses, your regular everyday expenses, and then you have your operating income, or we call it EBITDA, earnings before interest, taxes, and amortization. We look at that and we say, all right, how much debt can you really take on given your operating income? It's simply put, that's how it works. And we work with a certain ratio. The industry works with a certain ratio. The ratio which is used maybe in North America may be different from here, given our realities, but the industry typically works with a certain ratio. And that we're guided by that. It is not carved in stone, but we're guided by it. So essentially, that's what it is.
Okay. So, Kareem, on the debt side, they use debt service coverage ratio. But if you wanted to get equity, how would you know how to value a company? You know, I know sometimes it may be, I think it's very involved, but how on a high level would you say that you can say, all right, this is how much my company is worth, or they have to just come to you?
Yeah, so I think that's one of the tricky to answer. I think it's gonna be very company specific, if it's all, you know. So what with that valuation would entail is and sitting with the company, conducting, you know, sitting with them to understand the plans and strategies they have for the future, projections of what the next 5 years could look like for that company. Having all of that, then, you know, we would use a combination of techniques to being such as a discounted cash flows analysis. Talking about things such as a price, down into the, you know, the technical nitty-gritty, but safe to say that there are a number of techniques that are available, and depending on, you know, generates a lot of its value from the assets it has on its book. And probably the price to book multiple may be the best way to value that company. You know, but alternately, you could have a company that is able to generate, you know, a significant level of earnings without having significant hard assets or without having a big balance sheet. And in that instance, if you're to use a discounted cash flow value, or we have to use a price to earnings valuation approach. You know, so safe to say, once you come to us, we've worked through our we have models and everything that helps us to be able to compute and estimate, from our perspective, what this business could be worth very quickly, and then having said, come back to you and say, boy, this is what we're seeing, this is how value, based on the needs assessment and the amount of funding you're looking to get injected in the business. We are prepared to offer you this amount of money for this percentage stake in the company, and that then would start a little bit of a negotiation process. Kevin, we're not asking for everything. We've arrived on a position that we both are comfortable with. And we then trigger a process of additional due diligence where, knowing that, we have on paper, in principle, a deal on these terms, then we then do the deeper due diligence, which is a lot more involved. But I mean, again, I think our process is similar to the one Kevin mentioned, that before we go all the way down the wicket, we want to know that we at least have something that's conditionally approved before we start to do the real heavy lifting. So it's intended to be in the client world to ensure, we're not putting the company out to spend a lot of time on, putting together financing stuff that really and truly is not their core operations. We want you to focus on selling, want you to focus on driving your business, driving all the aspects that make your business work. Right. So that's a little bit of what our process looks like. And, we also have an internal, couple of layers of approvals that we have to get. So once it is that we have a thorough understanding of what the business is, what it does, and, what it could do in the future, we'd write up the transaction and present it to our committees for approval.
Okay. Kareem, I must say, I don't want to call out which internet service provider you're using, but
you guys not hearing me clearly?
To the end where you actually wrapped it up, and it gave a perfect summary. So I got it in the end. But
I spoke for 10 minutes and I'm not hearing nothing.
No, man, but what I want to
I see everybody nodding like you're following.
But what I want to find out too, is there a process that the company should start doing before they come to look for equity financing?
So we generally will meet you where you are, but as we explained earlier, with equity coming on, and now an equity investor becoming a share owner in the company. The company may have to have like a marriage where, we will now start to have board meetings frequently where, you'll be required to explain, what's happening with the company, the outlook for the company, how has the performance been recently. So in instances where companies didn't have that sort of governance structure in place, it's always helpful to start to think through, how you would implement such a structure. How would you put in, a board of directors that is meeting frequently to discuss the affairs of the company? It's always a good starting point.
Right. Okay. So, Kevin, in terms of debt financing, you can come in and you can get we talk about unsecured loan versus secured. Can you tell me the difference with those and when best to look at each one?
So unsecured loan simply is where the company or even the shareholders, directors do not have that hard asset to pledge on behalf of the company to secure a loan. So the bank, based on its due diligence, will have to make a decision. Do I lend to this client without taking any collateral at all? Typically, an unsecured loan will attract higher interest rates because of the general increased risk that's associated with those loans. And of course, your secured facilities will attract lower rates of interest, generally speaking. And what types of security do we accept? Because I suspect you're going there, Shani.
I am.
Of course, when you look at your balance sheet, the company's balance sheet, under your fixed assets, you will see property, plant, and equipment, and all that good stuff. We accept those as security. Of course, we like real estate. That's preferred form of security. But we'll also take your equipment. And I know there's an issue around specialized equipment. It is generally felt that banks prefer not to take specialized equipment as security, for the simple reason that it may be difficult to offload if the need arises. But we take specialized equipment, of course, as I said before, property. And what is important about us and how we organize ourselves is that we'll also use some of those current assets, your receivables. We do receivables financing, we do factoring. So let's say you are a manufacturer and you supply a large company and you've supplied your good and you've raised an invoice and you're awaiting payment. But now in these COVID times, it is taking longer to be repaid. You can come to JMMB and we can pay you on behalf of that, that bigger firm. So we can free you up so you can have some money and you can go to market again to come back. So those are some of the solutions that are there for our SME clients. And it works because a lot of money is tied up in the value chains, the various value chains in the SME segment. If more SMEs tap into this, they will have freed up a lot of capital and give themselves some more operating space. There are also other forms of security that's available. So for example, the DBJ has made available the CEF, Collateral Enhancement Fund. And what that does is DBJ as a development bank is saying, a lot of our SMEs do not have security, but we're prepared to pledge that security on behalf of the SMEs to the bank in exchange for the bank providing them funding at lower rates of interest and more flexible terms. I would encourage us SMEs to also look into that because that is a real opportunity there. So you can acquire lower cost funding. When you acquire lower cost funding, it makes you more competitive because your competition overseas and elsewhere, if they're accessing funding at a lower cost than you are, it means that they can sell cheaper than you can. So they're more competitive. And of course, Exim Bank really recently came out with their guarantee program in association with JMMB. We have exclusivity right now. And that's for exporters, persons who export goods, and those involved in the export market value chain. We will support you through a guarantee from the Exim Bank. So there are many opportunities out there to get funding, even if you do not yourself have the collateral support.
And Shani, if I can probably just jump in on the back of that comment is, on the equity side now, so I think this is probably one of the strongest selling points for taking on equity. Companies that don't have that sort of collateral, that is probably a prime candidate for taking on equity type financing. So I actually like to see companies that are, generating good, strong cash flows, but, if they may not have the collateral that the banks will accept, and, the part that Kevin probably didn't touch on a little bit is that, part of what constrains the bank are even the regulations within which we operate and what is deemed to be allowable collateral. But, on the equity side, we don't have those sort of constraints. But what it means is that we often are taking a much riskier position than a lending position. So, again, we'd also be looking for a higher rate of return to compensate us for the level of risk that we're taking. So I think for companies that, you have those things, you have everything else in place, but the collateral is something that's not there. You are a prime candidate for accessing equity financing.
So would you say that which one is cheaper? Is debt financing cheaper, or is equity financing cheaper, or is it dependent on who you are? So is there a standard for it?
So the literature will always tell you that equity financing is the most expensive type of financing you can raise, right? Because what it involves is you selling a piece of your business. So if the company does really, really well in the future, the equity investor who owns that 20 or 30% will command 20 or 30% of the performance of the company. But on the flip side, if the company does really, really poorly, that same equity investor has to also hug up those losses, right alongside you as the founder of that business. So for me, an equity investor is really a partner in the truest sense of the word. My equity investment only does well if the company does well. So it does not have the contractual cash flow obligations of debt financing. That when you take on your debt financing, every month you have to make that principal and interest payment. Equity financing is not structured in such a way. You actually do not have those type of contractual obligations. So how an equity investor will get paid is if the company now is doing well and is in a position now to pay dividends, then we could see some cash flows that come back. But by and large, we're hoping that over the medium term, over the longer term, say 3, 4, 5 years, we invest in a company that is worth $100 today, and we can help to grow that company to being worth $500, $600 in the future. That way, my investment, it becomes 5 or 6 times bigger than it was when we came in. And everybody does better off as a result of that. So that sort of is a construct of how equity financing works. It works even in instances where debt isn't able to go.
Right. And I heard you say earlier that, it's good to have a board of directors. So is it that if you get equity financing from JMMB, that you will now place somebody on that board?
That's correct. So so for instance, and again, I'm just throwing out random numbers. If we take a 30% equity stake in a company, we would generally be looking for, a roughly 30% representation of the board of directors, because we don't have that, again, we don't have that contractual payment flow to know when things are going right or going wrong. So, having our directors appointed is one of the ways that we use to, one, it does 2 things actually. One, it helps us to oversee the investment and manage our risk, because we now have the right to get, frequent information and updates on what's happening. But even more than that, what it allows us to do, we try to appoint directors to the company that can help to drive the values of these companies. So if we find an instance where a company is really, really strong in their sales, in their operations, and their back office support, but they really want a little bit of help in, say, HR, because it's just grown so quickly and it's becoming difficult to manage the number of staff members they have. What we'll try and do is have the directors that we appoint come with some of the skills that you need. So maybe we'd appoint one of our HR experts that can say to the company, this is sort of how you need to start to think about a performance appraisal program for your employees to ensure that persons are achieving the goals that will help to further the bigger strategic objectives of the company. Here's how you can put in a loyalty program. So we try to pair those skills with areas of need for the company. So I think that's one of the things that I am most proud of with our equity offering, is that not only do you get the financing, but we're actually also seeking to give you some level of at an oversight level technical expertise that can help to move your company from this stage to that stage.
Right. And I think that's perfect, because I realized too, on the equity side, JMMB is invested and they want to make sure that the company does well so that the investment does well. But I also know on the loan and the debt side is that, because I'm SME Resource Center, I'll say that with Kevin, we have that pairing where you do get a loan, but we're there working with you to give you that additional partnership that you need to make sure that your company is successful also, right, Kevin?
Right, and what I'm hearing coming out too is that wherever you go in JMMB, there's a partnership with the clients. There's a real partnership, not just anecdotal. It's real partnership.
And what about if a client wanted debt and equity? How would you guys go about doing something like that? Is that something that can happen?
For sure, for sure. We tag team on opportunities all the time. I may go in and say, boy, yes, this company is seeking equity financing to pursue this growth objective, but at the same time, they actually need a working capital line to help to manage their day-to-day. you know, and you know, I would reach over to our banking partners in Kevin and say, Kevin, you know, looking at this opportunity, and I think, you know, it works perfectly for the company to have this combined type of offering, and you know, we certainly would seek to structure that and ensure that we will put that in place.
Right.
So, Kevin, in terms of structuring, so same thing with Kareem asking about that mix. Is that something that works on your side when you're able to do part debt, part equity?
So what works is what works for the client. So we come from the client. It is what is best for the client, and we do, you know, what fits them now, but also because we'd have had that discussion from before, we'd have built out a path for them where we have an understanding that in the next 2 to 3 years, this is where you want to be. So we're not just looking at the now, but it is partnering with these clients through their various business life cycles. And hopefully we can take them to that point where we can call Kareem and say, Kareem, this client is not ready for some equity financing. They're growing so rapidly. And the kind of support they need now, we'll need to partner to assist the client. So that's how we work from the client based on their needs and what is best for them.
Right.
Yeah.
So, go ahead, Kareem.
Okay, so I was also going to add that, I mean, you know, for sure, coming from the perspective of the client, and sometimes, you know, taking on equity investing actually helps them to be able to get better terms even on the credit side, because what it means is that the balance sheet is, you know, equity investment helps to buffer that risk for the bank. You know, so you heard Kevin you know, talking that on the debt side, typically the rate on the interest, sorry, the interest rate on the loan, you know, is oftentimes tied to the riskiness of that particular company. If it is that there's that equity investment in there as that buffer, it generally helps to lower the risk for lenders, and you know, the company will benefit by getting a lower rate of interest on its borrowings.
I see we have a question here that's asking, this would be for Kareem, does JMMB have enough human resources to sit on these boards if we have about 200 companies that want equity financing? Like, first of all, would we be going to put in equity financing in 200 companies? Do we go to that level? And then do we have enough human resources? Are they all coming from JMMB?
No, so you know, really good question, Shani. So I think the truth is, you know, we probably could get to that 200 one day, but to say we'd be there tomorrow, I certainly don't believe that. You know, it's, you know, as you mentioned, it's very involved, and the human resources will come not just from JMMB though, but we scale our network. So you know, we have persons that we know that are external to JMMB. You know, so I mentioned before that, you know, we'll find a company that's looking for marketing expertise. You know, that marketing expertise could come from somebody internal to JMMB, or it could come from somebody external that we know that would be able to to provide the type of marketing support that this particular company needs. So I think in terms of the resources, you know, we leverage our own internal resources as well as external as well to be able to achieve a much wider scale. You know, so I think that sort of helps to see how we manage that HR perspective from our own side.
Right. So, Kevin, in terms of, so the person gets the loan, right? What are the obligations of the borrower after they've gotten this loan? Is it just that, okay, you have the loan and that's that? Or are there obligations after that the borrower should know about?
So there's an art in closing a deal, any deal at all, but as it relates to loans, when you're closing out that deal, it also requires a sit down and a conversation. The expectations under this agreement needs to be clearly understood between the parties. Of course, your first commitment is to repay your loan on time. That's your first commitment. But there are some other things that we'll look at. So typically, when you've gotten a loan from JMMB or you're approved for a loan, we'll do what we call a commitment letter that outlines all the agreements on understandings under this arrangement. So it tells you some very basic things, from the amount of money you're getting, how long you're getting to repay, the frequency of payment, effective interest rate, that type of thing. But what it will also communicate is what we call certain covenants that may govern this arrangement. And these covenants could be, for example, that there are certain ratios in your financial ratios that you should not exceed. So for example, we could say that the same debt service ratio that you spoke about earlier, it should not exceed 1.25 times. And we explain that. We will sit and speak to all those covenants so there's an understanding. It could be a requirement for you to provide us with financial statements every X period until the loan is repaid. So we on an interim basis, we can get a feel of what's happening in the business, so that if you're having some issues, it will not necessarily be a surprise to us, and we'll be able to assist you in a proactive way prior to things getting really bad. So that closeout discussion is very important, so that your banker conveys to you all the understandings and the expectations, and any questions that you have, anything you're not clear about, it is ventilated in that conversation.
And with that, so I had asked about the obligations of the borrower. Does JMMB keep in contact with their clients within the SME unit, or is it that you come for a loan and then that's until the loan is repaid? How do we work with clients?
What I like about SMEs is that SMEs are unique. Your needs are unique. No one solution will satisfy your needs. And as we say, it's a partnership. We keep on using the word partnership because that's what it is. Our clients go and call us almost every day. The relationship we want to have with our clients is that if an opportunity arises in your head, you wake up in the morning and you give us a call and say, what do you think about this? Do you think this can work? It is when we're at that place, do we truly know that we are in your world? So we don't leave our clients out to dry. What will sometimes happen is that you'll have a good client paying on time and you may not be hearing from them. We proactively reach out to our clients and just to get a feel of what's happening. And it is important that they are able to contact us. Now, this we take very, very seriously. Our clients must be able to contact us. It should never happen where a client is trying to reach one of our officers over any prolonged period, and it's not happening. I give out my telephone number every opportunity I get because I want my clients to get in touch with me if there's an issue. So it is a partnership, Shani, and that partnership dictates that we have to stay close to our clients.
Right. And then Kareem, on your side now, is there a set period of time? Do you, in terms of putting an equity investment, do you say, okay, I want to exit in 5 years? Is that set up front? How does that part of it work?
Yeah, so like Kevin, it's important to set expectations early and upfront, and that's generally before the money goes in, and a part of that will be, so yes, we've put in this equity investment and we're not getting monthly payments or periodic payments, but it's not free money. At some point in time, we expect that the value of our investment will become more, and we're able to exit at a handsome profit, to earn that return on our investment. We will have discussions up front around potentially what an exit could look like. It could mean, listing on the company on the stock exchange. It could mean, entering into a partnership with like a bigger person a bigger strategic partner, or even companies of similar size in the same industry where perhaps there's like a merger that comes together where, this company we're with partners with another company to create an even bigger company that is able to take on new opportunities. And in that, JMMB or whichever equity investor is able to exit, that's a possibility. Possibilities also exist where the company could actually borrow money to buy back the shares if it is that they want to exit in that way. So we would generally speak about what that exit opportunity could look like. We would generally speak around timelines around what we're striving for with that exit opportunity. We would also speak about the expectations around the information flow, frequency of board meetings, Whereas a loan agreement may have covenants, what we'd have on this side is things that we say, for these sort of material decisions, they have to come to the board for approval. So we try to beef up the governance a little bit, not too much where it gets in the way of the business being able to function and run and being agile and nimble and able to respond to market demands, but just enough to ensure that we do have some sight of what's happening, and we are able to lend our input into decisions that we think we can add value to.
So you had brought up a point that one of the exit strategies may be a company wanting to IPO. Does JMMB help with that?
So for sure, I mentioned earlier that we have a financing solution for you no matter where you are. So we have a capital markets unit that is one of the industry leading teams in the region as it relates to IPOs and other types of capital markets debt offerings as well. So once we get to the point of now looking for that IPO exit, there's a seamless solution that we're able to offer. We have a really, really strong partnership with our capital markets team that will be able to execute that in a seamless way for the client as possible.
So coming back to that point on Kevin's side, I didn't frame it in the beginning, but what size businesses do you look at? So where do you start within the SME unit?
Okay, so in the SME unit, we attend to clients whose revenues are between 15 million up to 425 million. That's it. That's a band. So, and those are SMEs. There are clients, there business clients who are earning below 15 million, and we still serve them, but they're served in the branches. Our unit serves clients who are 15 million and above, up to 425 in terms of revenues.
So we could kind of see where it is. So they start in branch, they come to SME unit. Within that, they may be able to, within our bracket, they may be able to get private equity financing. Or once they move from SME, they get to corporate and they can still get equity financing within corporate. And then after that, now we have our capital markets. So we're there for throughout the entire business life cycle, basically. Right?
So Shani, we would have moved clients, and for me, this is, this gives me personal joy. Would have moved clients from a small business when it came to us, or just a small business earning 20, when I say small business, by definition, earning like maybe $20 million per annum, and worked with them. But these people are diligent, work hard, know what they want, and they stick to the plan. And currently, they are graduated to our not capital markets, corporate banking. Yeah, sorry, corporate banking, where they're accessing over $700 million in loans and doing extremely well. That is, so if we were to measure ourselves on how well we're doing over time, that should be one metric. How are we moving clients from small business to medium to large businesses? Because that is how we're going to grow our economy. That is how we're going to allow companies to employ people and move our GDP forward.
Definitely. I see a question here. Does JMMB require clients to be banking with them for a defined period of time before they qualify for either conversation around debt financing or equity financing? So do you have to be a client of JMMB, and is it for a certain time, and then you could say, all right,
No, the short answer is no. We're prepared to have a conversation right away. Even if you're not a client of JMMB, we have a lot of clients to know when we first engage with them, all their banking business was elsewhere. All the banking business was elsewhere. But having engaged with us and see how we go about doing business, they kind of logged onto our program, and I hope are pretty satisfied. So no, the short answer is no.
Okay, and Kareem, on your side, you have to be, banking for some years before you could come and talk to you?
No, not at all. It's the same approach. You know, even brand new entities to the JMMB family, you know, we certainly will inject equity in. You know, the only thing is that if you were a client before, it probably helps with the shortening the needs assessment period because we'd have had a history with it and understand a lot more of the business. But I mean, you know, we would just as open, our doors are just as open to existing clients and new clients as well.
I see a question here, Kevin, but let me take it from a different angle. Is the credit rating the only requirement that you look at when assessing is to grant a loan?
Credit rating?
Credit rating, yeah.
All right, so when you speak about credit rating, we have to be specific. Financial institutions have internal models that they use to assess their clients. So our internal model tells us that if a client is rated X or Y, they are fit for borrowings or not. It is a key metric, but it's not the only metric that we use. So we'll have some clients who are rated pretty poorly, but we go beneath that because there's some information that feeds into what spits out a rating, and we go beneath that to understand what are those. And I'll give an example. Let's say you had a credit card that you didn't pay well. You got it, you didn't understand how to operate a credit card for the business or whatever. You didn't pay it well and it went not performing at some point. Or you got the credit card and you had some real emergencies. You took sick, you were ill, had to do surgery or something. And because of that, you now have a non-performing facility, or you had. Banks tend to frown on non-performing facilities. What it says is that it is, given that you did not pay on this facility, what is the likelihood that you'll pay my facility? In the most general sense. Instead of just saying to you, no, we can't assist you, we kind of go a little bit deeper. We try to understand what were the issues that caused you not to be able to pay. And if we can ascertain that, yes, man, this person had this serious illness and doctors attested to the illness and so on. And we look at some other things, realize that, but you behave well with your other debts and so on, then it allows us that leeway to still provide financing for you. So we try not to be hard and fast with how we look at things. We really look at the issues, and if we say we can't help in that way, this time it would have been after we were really taking a serious look at how we could possibly help with financing.
Right. And in terms of, because I see questions coming in terms of, what would have happened to clients during COVID, but just can you highlight what we at JMMB did for our clients during this period?
All right, so last year when COVID hit, I think it was around March, Sean and I were in some deep planning about how we're gonna, be aggressive in the SME space, and then COVID hit and we had to step back. And if you know anything about JMMB, this will not surprise you, but one of the first things that we did was to ascertain how are we gonna take care of our clients. Because we realized that, especially in the SME space, you're gonna be very vulnerable due to this COVID that came out of the blue. So we stepped back a bit from being aggressive in growth to ascertaining how can we reach out to our clients and put things in place to support them. So one of the things that we did was to have conversations, one-on-one calls with clients. Tell me what the situation is. How do you think this COVID will affect you? You're not so sure? Can we reach back out to you in 2 weeks' time, and so on? And we would have granted to our clients moratorium based on their specific situation. We developed what I consider a very, it's almost unique in the space, or a moratorium package, in that we did not just say, you know what, we'll give you 3 months break or 6 months interest only payment. We went as far as to say we could do another facility that's a debt servicing facility for you. It was based on your specific situation at that particular time. And I'm happy to say that it has worked. When you look at our portfolio, our performing portfolio, those are loans which are not delinquent. It is extremely healthy. As usual, JMMB has one of the best performing portfolios in Jamaica, despite our intense growth over the years. So we're extremely proud of that. And it's testimony to how we, I believe, wrapped our arms around our clients when they needed us the most. And so, to the question, your credit rating is not affected if we gave you a moratorium, because the understanding between the banks and the credit bureaus to whom we report is that we would have paused your situation right there, let's say in March. So though you got that moratorium and you weren't paying, we're not reporting that you're not paying. The understanding is that your situation is paused, and what we report to the credit bureau is that given that time period, your credit rating should not be affected.
Right. That's great. And I mean, I think if some of these clients who are not JMMB clients knew that before, they would be banking with JMMB. Kareem, is credit rating something you guys look at in equity financing?
I mean, it's not one of the leading things we look at, you know. But if we uncover that the company has had a bad credit history, it certainly is cause for a discussion, you know, for us to understand what was behind that. And again, so once you take on an equity partner, it really becomes a marriage. So you have to be comfortable with me as an investor, and I have to be comfortable with you as the principals are going to be running the company. It's going to take my money, and I need to be comfortable that you're a good steward of my invested capital. So if it is that we'll go through and we understand that there were reasons that would have impacted why you had that negative credit performance during that specific period of time, it's certainly something that is forgivable. But I mean, if there's a negative credit report, is something that we don't want to understand.
Right. You may have raised it earlier, but I want to find out. So when you go, so with that, you have a certain interest rate, you pay back that on a monthly basis, or whatever your terms are with your bank. But with equity financing, is there a magic percentage that you say, all right, I want to, in 5 years, I want to come out of this, but I want to have made 100% profit? So what are you looking for as a return? Or in the industry, is there a number?
And again, it's hard to say that there is a number, because it again is going to be dependent on the specifics of each opportunity, and just more broadly, the riskier the opportunity that we're investing in is the higher we higher rate of return we'll be looking for to compensate us for taking on that level of risk. If an investment is less risky, we could be willing to accept a lower rate of return because it's not as risky as another one that really we need that additional compensation for. But I would get that range of returns would certainly be north of what you would get on a bank type financing facility. So certainly at least in the teens.
Okay.
Yeah.
All right. Good. So in terms of debt financing, you don't have a number that you look at. You have your rates and you work with it with your clients. When clients come in and they have been through the process, what are some additional benefits that they get from banking with JMMB? Are there any additional benefits for being a client with JMMB?
So sure. So once we've had that discussion and we're taking you on board as our client, you're not just a client of the bank, you're a client for the group. And what does JMMB Group include? We offer insurance services, we offer pension, we offer investment advice. Kareem will offer you equity investments. And if you move to the capital markets, then you're looking to play with the bigger guys. What we have here is a serious ecosystem of support for our clients. And I mentioned this last because this is unique. Well, JMMB has it in a unique way, our SME Resource Center. We work closely with the SME Resource Center to upskill our clients, to provide to our clients that additional handholding that is required. You know, Shani would know that a couple years ago when we were doing some research to kind of understand what our clients want, how should we serve them. A recurring theme was that the banks do not care enough about them. The banks do not kind of offer services tailored to their specific needs and so on. So it only made sense that we came up with this resource center, and Shani is doing an excellent job at it in just providing that additional handholding to our clients. I see it work, and it works really well. So you are exposed to the ecosystem here at JMMB Group that caters to your individual need right along your journey.
Kevin, I have a hard question here for you in the chat.
You should probably ask Kareem then.
It's specific to you in terms of, do you have specific processing times for loans?
All right. So following that conversation that we have with our clients, we aim to be able, well, following that conversation, we'll say to you that these are the things that we need to make a submission on your behalf. Internally, we have some benchmarks. We would love to be able to make a presentation within 48 hours after getting the information. It may not always work that way, but I'd certainly say within the first 5 days, we should be able to make that submission on your behalf. And it is subject to the complexity of the request. In reality, some applications are way more complex than others and requires a way more research on our part. And again, because if a client is not totally ready, or what some other banks would consider not totally ready in terms of their financial statements and so on, instead of turning you away, we'll sit with you and work through that process and help you to build up those financial statements. And those things can take a while because we kind of invest some time to kind of make the presentation fit to be submitted to our credit risk department. So let's say that takes a week. Our credit risk team will, for the most part, come back to us with a response, I'd say within 48 hours. And that's a first response. Now, if they say, look here, I like this submission, your client is conditionally approved. So these are the other 6 things that they need to come with to get that final approval, and we communicate that to our client. So you could have a conditional approval, I'd say, in a week or just over a week.
And what I want to ask for both of you, are there specific industries that you look on, or it doesn't matter?
You know, so for us on this side, you know, we generally are industry agnostic. You know, we will look on generally all industries, even those that you know, right now may be out of favor, you know, because our timeline, you know, equity financing is a lot more patient. You know, so our timelines are, you know, as we mentioned earlier, could be, you know, 5-6 years. So if it is that the industries is negatively impacted today, and you know, but we view it as having good long-term viability and a good option for returning to profitability, it's certainly something that we would be happy to look at. Yeah, but we look on all industries.
And Kevin, on your side?
Yeah, we're a little different. The timeline given our transactions may be a little bit shorter. So if, for example, a particular industry is under threat, let's say, for example, under COVID, we know that tourism has taken a hit and the entertainment industry and so on. We would be very cautious in lending to persons in this industry. We've, of course, lent money to them, but it takes on a little bit more complexity in this time, given that their cash flow is seriously affected. And you know, interestingly enough, we have structured ourselves in such a way that we've still lent money to persons in these industries, but it is a way it is structured. So we could give you, for example, like a 6-month period that say pay interest only until for over this 6-month period. And so it gives you time and breathing space. So your cash flow is not significantly or overly affected during that time. But you'd have gotten some money to retool. It could be that you wanted to fix up a property. It could be that you wanted to get some new equipment in preparation for when life starts to keep fully again in your space. So you would have been ready and raring to go when that time comes.
And I must attest to the interest rates only, because also I've seen it happen where people, when they get that relief, they have time to say, all right, I could come back again, you know? So there's some relief given, and then they're able to say, all right, I'm ready again to be able to pay my loan. So JMMB is able to give you, you know, different options at different periods.
It is, what is important to Shani is that when we're offering financing, so let's say you need $100 for your business. Getting $100 is fine, but what type of financing is best suited for you? I could give you a term loan where you pay a fixed amount every month, X rate, but is that the right type of financing? So despite the fact that you're getting financing, would, for example, a line of credit better suit you, given your cash conversion cycle? So we tend to look at your cash flow carefully. And this is why, too, it is important that as a business, if you can maintain good financial records, it's really, really good, because it helps us in our assessment to serve it better. So when you come into us and you have those financial statements ready, excuse me, and they're up to standard, and we can really do some assessment on it, it helps us to make some better decisions in serving you. So we can see the gap in timing between your receivables and payables, for example. We could say that in addition to this term loan, you're going to also potentially need a line of credit. You may not use it, but we can put it in place just in case you need to draw on it some point down the road, and it makes life easier for you. So it is tied to your cash flow and the timing of your cash flow. And that is extremely important.
Right, definitely. So what we're going to do now is that I am going to open up to other questions. I mean, I've been taking some questions from the chat, but you guys are free to open your mics if you have any questions that you want to ask, or you're free to put it in the chat also. Ozette, right? Ozette is Brehon, right? Yes, see, I know. She said that I must attest to all these methods and strategies and hand-holding for SMEs. JMMB has offered me, my company, comfort during these difficult times. So, Ozette, we all know your name. The Resource Center. You see, I knew your company as soon as I saw your name. So, and that's the thing. So some clients may not know me, or they may not know Kevin, but trust, we know all of you. Because, you know, we make sure that we have discussions about each client and what is best for that client. So did I miss any questions?
So Shani, we actually have one question from Christopher, and I think this is more for Kareem. So he's asking, what are the main criteria to qualify as an equity partner? I think he means to qualify for equity investment. So what are some of the things that he has to have in order to qualify for that financing?
All right, thanks for that. The question is from Christopher. Thanks, Christopher. So I mean, I think the important thing to take away here is that you know, we are flexible. You know, so once it is that you have, you know, growth opportunities on the horizon, there's a good outlook for the company for the next 5 years. You know, you have a strong management team in place. You know, and you check that that revenue threshold that we mentioned. Then, you know, it certainly qualifies you to be a good candidate for receiving JMMB, you know, private equity financing.
Okay, great. I'm just checking the chat to see if we have any other questions that we may have missed. Okay, I'm not seeing any, but I have a big question, and this one is for Kevin. You mentioned moratoriums earlier when we were discussing our response to the COVID pandemic, the COVID crisis. What is the difference between a deferral versus a moratorium?
So a moratorium takes various forms. Am I okay? It may take various forms. Typically, when you give a moratorium, we're saying that you are foregoing paying on the principal for X period of months. For example, if your payments are monthly. So we could give a moratorium for 6 months. I've seen clients get moratorium for over 12 months in COVID. And thank God that the BOJ was very accommodating during this time in helping us to help our clients. It must be said, we oftentimes BOJ gets a bad rap, but I think they really worked with the commercial banks during COVID to give us that space to work with our clients. And a deferral is where you get a total payment holiday. And during COVID, it was usually 3 months that banks would extend those deferrals for. And again, it would depend on the discussion with your client. If a client says, listen, I can't find $1 to make a payment, they know that maybe that deferral is good for the client. However, the client may not be able to find $1, and we could give a deferral for 3 months, but what will happen subsequent to that 3 months? Maybe they still can't find $1 depending on where they are. So we kind of came up with some other solutions for those clients that work for them, where they still didn't need to come out of pocket, but their payments were being made.
Thanks for that.
Sure.
Kevin, question here. So you had made reference to the so if a client wants to avail themselves of any type of DBJ loan, do they go to DBJ or do they come to the bank? Where do they go?
DBJ does not lend directly to the market, except for, as far as I know, BPOs. They had piloted a loan for BPOs, and I know that they're in that space. But typically, the funds that DBJ may want to lend to the market is lend through the AFIs. So AFIs are, JMMB, the other commercial banks, and so on. So we act on behalf of the DBJ to extend funding to the end user, the client. But that is if we're using their funding. The question is, the rate that their funding is coming out at, is it in the best interest of the client? So we take those decisions also based on. Yeah.
So if a client comes to you and they say, I want a DBJ loan, you will make that assessment.
So we have to be careful enough, because DBJ advertises a lot about their offerings, and sometimes there's some confusion about a DBJ loan versus the collateral enhancement fund. I've seen this a lot, where the DBJ advertises that, listen, we have this facility in place, and speak to your banker about it. But what it really is speaking to is the collateral support and not funding itself. There's a clear distinction to be made.
Mm-hmm.
The collateral support is this: you're borrowing a loan from an AFI, from a bank, from JMMB, of course, and the DBJ is prepared to provide that collateral support via the CEF. There's a clear distinction to be made. That versus drawing down on funding provided by the DBJ to on-lend to the client.
Okay, and I have another question for Kareem. In terms of, so we mentioned a couple different types of equity financing, but what would you say is the main difference between angel investing and private equity?
Mm-hmm. So thanks, Ali. I think the major difference would be the stage of the companies that are invested in. So for angel investing, it's typically companies that are an earlier stage in their life cycle. So, that's companies that are actually at the startup stage, or, they have a good concept or a good product that they want to bring to market, but they may be pre-revenue. They haven't started operating as a business as yet. What angel investing would look like is that early stage investment, as well as some amount of business mentoring. So you'd have, well, the angels would be, generally persons who have been around, who have built businesses that could also lend that type of support to help those early stage companies to navigate those, those tricky startup waters, to be able to move that concept into a viable business opportunity that, can develop and advance to the bigger stages of funding. And while the private equity offering is a little bit more mature, so companies that have gone through that startup phase, are now operating at a level with a track record of performance, and are now looking to again make that bigger leap from being in that middle income stage to be, to going up there and graduating to be among the big boys. So I think that really is the primary difference between the two, the stage of the companies that are invested in.
Okay, great. And then I'm seeing another question just to tack on to that in the chat. How quickly does the equity financing process take? How quick is it? How long does it take on average?
Yeah, so I mean, it does take a little bit of, it does take a little bit of time, because I mentioned that in that there is a due diligence process that we have to, we have to go through, where we go into the business and, right there with you, we're kicking the tires to ensure that, we get a thorough understanding of how the business operates. What are some of the potential, risks to look out for? What are some of the areas of improvements that we could help to drive value, to move the business along that continuum of growth? And that due diligence process is one that could take, anywhere between, 4 to 12 weeks, right? And the huge variation in time is often dependent on, to Kevin's point that he raised earlier, the quality of information and record keeping that the company has. So we will request certain information, and if that information is forthcoming sooner rather than later, then that process could be wrapped up in 4 weeks. If it takes a little bit longer to put together that information, then, probably pushing out to, 8 weeks, possibly as much as 12 weeks, right? So it does take a little bit more planning and organization to be able to tap into that equity funding. But, certainly haven't gone through that. What our clients have said is that it certainly was worth the due diligence, because even they uncover a lot about themselves during that process that they're able to take forward and help to grow the business.
Great, thanks for that.
So thank you, Kareem, and thank you, Kevin. Thank you, everyone on the panel. I'm sure that everyone learned some very valuable information today. Even if it's not something that you'll be using now, I'm sure it will come in handy in the future. We also have another session going on for JMMB. So when you are finished here tonight, please feel free to go to our YouTube page. So that's JMMB Group YouTube page. We are going to be having a few of our experts on our Go Getter Live session. So we'll have persons from pension and other departments. So feel free to join them. Of course, if you are interested in becoming a JMMB SME Resource Center client, if you are not, please reach out to us. Our email address, once again, is SMEResourceCenter@JMMB. We are more than happy to have a conversation with you to discuss exactly how we can assist you. So thank you once again, everyone, for coming out, and look out for our next session.
And then also, if there are any other questions that we weren't able to take, you can always email us at SMEResourceCenter@jmmb.com. And you can also get the contact for our team members by reaching out to us also. So thank you guys for coming out this evening. Have a great evening. Thank you, Kevin. Thank you, Kareem, for a great informative discussion on debt versus equity.
You're welcome.
Thanks for everybody, enjoy the rest of the evening.
Bye everyone, have a good evening.